Welcome to Alfonso Cajero, Financial Modeling Tutorials. Chapter 14, E-commerce Startup Valuation. Financial Modeling. Welcome to our guide on e-commerce startup valuation and financial modeling. In this video, we'll cover the essentials of building a financial model for an e-commerce startup and how to accurately value your business. Whether you're a founder, investor, or financial analyst, understanding how to model and value an e-commerce startup is crucial for making informed decisions and securing funding. 1. Introduction to e-commerce startup. Valuation. Valuing an e-commerce startup involves estimating its worth based on current and projected financial performance. Unlike established companies, startups often have limited historical data, so valuation relies heavily on forecasts and assumptions. Key factors include revenue potential, customer acquisition costs, growth rates, and profitability. 2. Gathering data and assumptions. Start by gathering all relevant data and setting up assumptions. This includes historical financial data if available, and key metrics such as revenue streams. Identify different revenue sources like product sales, subscription fees, or advertising income. Customer metrics include customer acquisition cost, CAC, customer lifetime value, CLV, and churn rate. Market data. Consider market size, growth trends, and competitive landscape. Document these assumptions in your model, ensuring they are realistic and based on industry benchmarks or market research. 3. Building the financial model. Your financial model should consist of several key components. Revenue projections. Forecast future revenues based on your business model. Use historical data if available, and apply growth rates based on market research and business strategy. Factor in seasonality or market trends that could impact sales. Cost structure. Estimate both fixed and variable costs. Fixed costs may include salaries, rent, and software subscriptions, while variable costs could include cost of goods sold, COGS, shipping, and transaction fees. Profitability metrics. Calculate gross profit, operating profit, and net profit. Include projections for EBITDA, earnings before interest, taxes, depreciation, and amortization, to assess operational efficiency. Cash flow. Projections. Develop detailed cash flow statements to track cash inflows from sales and outflows from expenses and investments. Ensure to include working capital changes and any planned capital expenditures. Valuation methods. Use appropriate valuation methods to estimate the startup's worth. Common approaches include discounted cash flow, DCF. Analysis. Calculate the present value of future cash flows using a discount rate that reflects the startup's risk. Comparable company analysis. Compare your startup to similar publicly traded companies or recent transactions in the e-commerce sector. Precedent transactions. Analyze valuations of similar startups that have recently been acquired or received funding. 4. Sensitivity and scenario. Analysis. Conduct sensitivity and scenario analysis to understand how changes in key assumptions impact your valuation. For example, analyze how variations in customer acquisition cost or revenue growth affect profitability and cash flow. This helps in assessing risks and making informed decisions. 5. Reviewing and refining the model. Review and refine your financial model to ensure accuracy and consistency. Cross-check your projections with industry benchmarks and validate assumptions. Update the model as new data becomes available or as business conditions change. 6. Presenting your valuation. When presenting your valuation, clearly communicate key findings and assumptions. Use charts, graphs, and summaries to highlight critical metrics and insights. Ensure that your presentation provides a comprehensive view of the startup's financial health and value. 7. Ongoing monitoring and updates. Regularly monitor and update your financial model and valuation as your e-commerce startup grows and evolves. This will help in making informed decisions and attracting potential investors or partners. Conclusion: building a financial model and performing valuation for an e-commerce startup involves projecting future performance, estimating costs, and applying valuation methods. By following these steps, you can create a robust model that supports strategic decisions and helps in securing funding. Thank you for watching. If you found this guide helpful, please like, comment, and subscribe for more insights into financial modeling and startup valuation.